first issue in this case is about revenue recognition in transaction with Omega Trading Berhad, where in December 2025, NTK sold goods to Omega Trading Berhad, and they are only required to pay NTK once the goods are sold to end customers. However, Ahmad instructed the accountant to recognize the revenue immediately. The MFRS related to this case is MFRS 15, Revenue from Contract with Customer, where MFRS 15 states that revenue is only recognized once control of goods or services transfers to the customer. But in this case, the revenue was recognized immediately, even though Omega was only required to make payment after the goods are successfully sold to end customers. Therefore, the management, they need to assess whether the control of goods has been transferred to Omega. And since the payment is only made after the goods are sold to end customers, they should not recognize the revenue immediately, but instead they should recognize it once the payment has been made, where the goods are finally sold to the end customers. And the effect to the financial statement is that since the revenue is recognized before the performance obligation was satisfied, the revenue reported for the year could be higher than it should be. The second issue in this case is about revision of useful life of assets, where Ahmad, he decided to revise the useful lives of several high-value assets at NTK's manufacturing facility without any proper assessment or justification that reflects to the asset's actual condition and how they were being used. So there are two MFRS related to this issue. Number one is MFRS 116, Property, Plant and Equipment, PPE, where it states that the useful life of PPE should be reviewed periodically and depreciation should be adjusted if estimates change significantly. And the second MFRS is MFRS 108, Accounting Policies, Changes in Accounting Estimates and Errors. This MFRS states that the revision of useful life is a change in accounting estimate and must be applied prospectively. The application in this case is that Ahmad, he revised the useful lives of high-value assets without any proper technical assessment or justification. Therefore, the management, they should assess whether the assets will generate how long the assets will generate economic benefits, and do a professional judgment to determine whether the revision is reasonable. That is what it's supposed to be. But in NTK, the revision of the useful lives were made without any proper technical assessment and justification. So this will affect in the depreciation and valuation of PPE, since the revision of useful life of assets were made without any proper technical assessment and justification. The revision of useful lives made may result in inappropriate depreciation expense being recognized, carrying the value amount of PPE and profit to be misstated.
Next, I will explain the ethical analysis of this case. There are two main ethical issues identified. The first issue is premature revenue recognition, which does not comply with MFRS 15. Although the goods were delivered, the company recognized the revenue immediately, even though the customer only pays after selling the goods to the end customers. This means the performance obligation has not been fully satisfied, so the revenue should not be recognized at that time. The second issue is the unjustified revision of the useful life of asset, which is against MFRS 116. Management extended the useful life of the asset without sufficient evidence, which reduces the depreciation expense and artificially increases the company profit. This action created an ethical dilemma for Alia, the accountant. She had to choose between following Ahmad's instruction or complying with the Malaysian financial reporting standard. There were also three ethical threats faced by Alia. First is intimidation, because she was afraid of losing her job if she refused management instruction. Second is self-interest, as she wanted to protect her probation position and secure her employment. Third is undue influence, where management pressured her to apply inappropriate accounting treatments instead of following professional standards. As a professional accountant, Alia should prioritize integrity, objectivity, and compliance with MFRS despite the pressure from management. Now, I will explain how the other principle can be applied to this case using the OTUR3 and NIAMN frameworks. First is OTUR3. We begin with observe by identifying that the company manipulates its financial reporting through inappropriate accounting practice. Next is think, where we consider how this manipulation affects investors, lenders, auditors, and the public who all rely on accurate financial information. Then, understand the reasons behind this action. In this case, management was motivated by the desire to increase profit, receive bonus, and meet loan covenant requirement. After that, we remember the importance of maintaining integrity, objectivity, and compliance with MFRS, which are the fundamental responsibilities of professional accountants. Finally, reflect and remorse means the company should correct the financial statement, disclose any material errors, and strengthen its ethical culture to prevent similar issues in the future. The second framework is NIAMN. Niat or intention was to increase profit and meet loan covenants. However, the ikhtiar of effort used was unethical because management applied inappropriate accounting treatments. This violated amanah, which means trust and professional responsibility. From the perspective of muraqabah, everyone should remember that they are accountable not only to stakeholders but also to Allah for their actions. Finally, natija or outcome was misleading financial reports, legal risks, and loss of trust from investors and the public. So overall, applying these other principles reminds us that ethical decision should always be guided by honesty, responsibility, and accountability.
Next, I will present our recommendation to address the issue of revenue recognition and the revision of useful life of manufacturing asset. Firstly, for revenue recognition, NTK should recognize revenue only when all the criteria under MFRS 15 are met. Since Omega Trading only pays after selling the goods to end customer, NTK should first assess whether the transaction is a consignment arrangement or not, before recognizing it as a revenue. In addition, significant sales transaction should go through a proper approval process to make sure compliance with the accounting standard. This helps to ensure accurate revenue recognition and reduce the risk of earning manipulation. Secondly, for the revision of useful life, NTK should revise the useful life of its manufacturing asset only when there is a proper technical evidence. The company should obtain an independent engineering assessment and required approval from the audit community before making any significant changes. This measure helped ensure the depreciation estimates are reliable while improving transparency and accountability. Overall, this recommendation strengthens internal control, promote ethical financial reporting, and enhance stakeholder confidence.
We must lower the risk of deliberate mischaracterization of sales by avoiding aggressive revenue recognition. In practice, NTK cannot record revenue when goods leave the warehouse if Omega only pays after selling it to end users. Sticking to this ensures our financial statements reflect real performance and keeps us safe within our bank governance. Second, we need to remove absolute decision-making power from Director Ahmad by enhancing internal controls. Implementing a multi-level review process ensures no single individual can override the system to hit personal targets. To ensure continuous compliance, we will establish a strict checklist for sales contract to verify that control has genuinely shifted to customer under FAR 15. Finally, any revision to asset useful life must remain realistic and be strictly backed by verifiable technical documentation. Without clear documented justification, adjustment to depreciation cannot be passed. First, we must provide objective criteria for employees to rely upon. Establishing clear accounting policies and independent whistleblowing channel shields vulnerable employees like Alia from unfair intimidation or top-down management pressure. This gives them concrete support to defend their technical judgment against unethical orders. Second, we need transparency as the core objective of management. By shifting our corporate culture away from unquestioned obedience and toward valuing the truth over personal bonuses, financial professionals can confidently uphold their integrity and practice with absolute objectivity. Third, we must build long-term trust by protecting the company's going concern status over the long run. Concealing major events like Apple Tech's bankruptcy is a short-term gamble. True sustainability means disclosing bad news transparently under MFRS 110 to preserve market credibility. Finally, practicing adab in governance must become the practical way of management within the firm. By aligning niyat, iktihar, and amanah, we ensure stakeholders and banks can trust our financial statements, securing our long-term financial health. In conclusion, complying with financial reporting standards is absolutely vital for any firm. These standards ensure our financial health is transparent and accurate. Sticking to these rules is also the only way to prevent a bad reputation caused by report manipulation. Massaging the numbers always backfires and destroys market trust. Ultimately, we must treat ethical conduct and technical compliance as our absolute foundational priority. For NTK Corporation, integrity must always come before short-term performance target. That's all from us. Thank you.